Ladies and gentlemen, please welcome Harshendu Bindal.
Thanks, Shelley. Ladies and gentlemen, welcome to Perspective, a conversation with thought leaders. Vivek mentioned, and before that, Shelley, that we have a wide spectrum of subjects that we are going to talk about. We have an exciting set of thought leaders who are going to present those ideas to you. But what we thought we would do is we would start by talking about an industry which all of us are associated with, which is the asset management industry, or as we like to call it in India, the mutual fund industry. To give us a perspective on the industry, we have two very special guests in Jenny Johnson and Vijay Advani, co-presidents of Franklin Templeton Investments, who've come all the way from San Mateo, California. I would like to request Jenny and Vijay to please join me on stage. So before we start our conversation, I would like to spend a couple of minutes introducing Jenny and Vijay. Jenny Johnson joined the firm in 1988 and today oversees the company's global transfer agency operations, investment services, technology, human resources, and fiduciary trust company international. She has previously served as the Chief Information Officer. Vijay's journey with Franklin Templeton started right here in Mumbai in 1995, and he started the India operations out of a hotel room in Nariman Point. Today, Vijay is responsible for the company's global and retail and institutional strategies and initiatives, including sales, marketing, client services, and product development. As co-presidents, Jenny and Vijay jointly oversee investment management and all related investment management support services, including trading and risk management. Thank you both once again for being with us here today. Before I deep dive into the investment management industry, what I thought I would do is start by talking about an area which definitely impacts business in India, which is government policy. So, Vijay, let me start with you. India had a change of government in May 2014 with Narendra Modi of BJP as the Prime Minister. The Prime Minister subsequently has traveled quite extensively to several countries where he has promoted India as a business-friendly destination to global leaders as well as foreign heads of governments. So what I wanted to know was, in your opinion, what does India need to do so that we can attract foreign investors in larger numbers, and especially for big ticket FDI?
Firstly, thank you, and good morning, ladies and gentlemen. It's great to be back. It's been a long journey, as Harshendu said, from 1995. Many of you I met yesterday at dinner, and I look forward to meeting you and socializing with you over the coffee break to see how your journey has evolved. Harshendu, I think there are basically three areas that I see as areas that India and the Indian policy makers can do to attract foreign investment. The first really is on the FII flows. It's kind of ironic that notwithstanding the growth in the stock market, the GDP, India's size, India's weightage in the MSCI is only 8%. Compare that to Korea and Taiwan, which is north of 15%. And we all know, all of us here in the room, that asset managers get ranked based on performance, especially equity managers, based on the index, some kind of index, whether you're passive or active. And MSCI is the real index that most people look to. So if you have only an 8% weightage, you're not going to see billions of dollars flowing into the country. And one of the reasons for that is, and I raised this with SEBI and the Ministry of Finance, is that the free float in India is yet very low. Most of the companies, the large cap companies, are promoter run or big industrial houses. And while the government has passed regulations to allow foreign institutional investors to go from 49% to 54%, you need to pass an extraordinary resolution to do that. And what I've recommended and we've recommended to the government is allow automatically for foreign investors to go up to 74%, unless you pass an extraordinary resolution to take it down to 49. That will kind of force a debate, why are you bringing it down? So that's one thing. And I think once India's weightage actually increases, you're going to see both index funds and active funds increase their investment. The second is, how does India become a global financial center? In most countries, including the United States and actually even emerging markets, the critical IP is the portfolio management of the person who's managing these assets. Now, there are various lines of business, whether it's pensions, separate accounts, high net worth accounts, mutual funds. In India, you need separate licenses and separate portfolio managers. As a result, there's fragmentation of the industry. So one other recommendation is to combine this into one so that you can actually see scale increasing. And then lastly, even though this is not a foreign investment, but I thought I'd kind of raise it because we have raised it with the government, is the domestic pension reform. I mean, 480 million people in India are not covered by pensions. And as these individual citizens grow older, they will become a burden on the state. And so if you look at Malaysia and Chile, their pension business is 50% of the GDP. In the US and UK, it's 120% of GDP. In India, it's less than 6%. So how do you actually have that pension reform so that asset managers can manage this? So these are the three areas: the pensions, the FII investment, and how do you make this a global financial center?
Thanks. Jenny, Franklin Templeton has invested in several countries. Can you share with us some examples where government policy has played an important role in fueling the growth, specifically of the asset management industry?
Well, first, let me just say that it's great to be here, and India is an incredibly important part of our business, and we could not be successful without all of you. So thank you, and it is my great honor to be here. As we look to grow our business, so of course, we invest in over 160 countries from an investment perspective, but we actually have offices in 35 countries and slightly less with kind of a local asset management business. But the way we tend to approach that is we'll look at a country, we'll look at factors like demographics, we'll look at factors like GDP growth. You're really trying to assess what is the trajectory of the economy and the opportunity of the growth. And then you look at it and you say, and then what's the environment? What's the regulatory environment? Are they positive and constructive? Are they trying to really help kind of grow an industry, or do they tend to get in the way of themselves? So, things that can become issues. Regulatory arbitrage is always a dangerous thing because it pushes people in a sector that isn't necessarily best for them or products that are best for them. So those are always concerns. You're looking for where the government, as Vijay mentioned, in pensions. Where's the government supporting pension reform and supporting kind of investment? We tend to be comfortable going in early. We like to actually take time to invest and build those relationships, provided we're received in such a way that people, as I said, want to be constructive in it. I think our view is you have to, if you're going to plant a garden, no matter how healthy the plant is that you're going to plant, if the soil isn't right, it's never going to grow. So we're looking for an environment where the soil's right.
Interesting. And I think it also plays out when we entered India in 1995. I think, Vijay, we may have seen some of the similar conditions at that point in time. So let's move on to something more closer in terms of the industry. And Vijay, this is for you. With the global distribution landscape changing, can you throw light on some of the emerging trends that you're witnessing across various countries across the globe?
As I travel from Japan to Chile, I mean, every country is a snowflake. So you see different regulations, different issues in each country. But the reality is everyone's moving in the same direction. It's maybe 2 steps forward, 1 step back, but directionally, it's the same. I think the 2 broad changes that are taking place globally at different pace. One is moving away, and I know this in India is very close to all of your heart, is the business moving away from commission-based to fee-based. So if you take our own business, Franklin Templeton's in the US, 80-90% of our business used to come from commission base, which was the front-end load. Today, not because of regulation, but because of evolution over time, 70% of our business today, retail business in the US, is fee-based. So it has automatically moved to a fee-based thing. And that directionally we are seeing in Europe, in Asia, and obviously here in India, and I'm sure we'll talk about it more over the course of the day. So that's one big change that is taking place. And then the second is moving away from selling products to selling solutions and goals. Because at the end of the day, your client is saving, he or she is saving for a particular goal, whether it's a lifestyle, whether it's retirement, marriage, housing, education. And it's no longer trying to push a product that is hot. How do you hold your hand of your client and take him or her to achieving that goal? And in fact, a lot of behavioral economists have said that when you interview a client and just ask him or her about the risk profile, they give you one answer, which may be, I'm happy to take more risk or less risk. But when you ask them about their risk profile of different goals, you typically get 6 or 7 answers. And so each goal has a very different risk profile. And so I think these are the two main areas, is moving away from product to solutions or goal-based. And second is the trend moving away from commission-based to fee-based.
Quite interesting. In India, you talked about US, it came through market evolution. In India, we are seeing some of that happen through regulation, and I think that's where some of the concerns are coming from. So there's another trend which is actually impacting the industry quite a bit, and that's the impact of technology. So Jenny, especially as it relates to distribution, how do what are some of the trends that you see emerge as a result of the impact of technology on the distribution space?
So let me address it as an industry, but I'll start with distribution. So, where technology, particularly in a place like India, where you have such a huge population, what technology can enable you to do on the distribution side is to scale. And what does your client really want? And you as financial advisors, our client, what do you want? You want timely information delivered to you in an easy way to consume it, in the way in which you want to receive it. So if you take a place like India, where you have about 400 million people who have access to the internet, but 980 million people who have access to mobile phones, your technical solution to deliver that timely information is very different. And so it's actually a very complex problem. But your ability to do it and your need to do it is critical. And so it's getting easier. So the same information delivered over a website, over a mobile app, or over a mobile is actually a different technology solution, and yet you're delivering the same information. And so, I think that's getting better and better, and I think since advisors, clients demand them to be able to communicate more quickly, our being able to get it out to them is absolutely essential. So I think you'll see that on the distribution side and the service side. On the investment side, I think there's some really interesting things developing. We all think about applying data analytics and investment on the active management side to kind of structured data. But what's happening in the technology is the ability to really apply analytics on unstructured data. So what do I mean by that? So if you think about, many would argue that where the global economy, one of the big factors in how the global economy performs is how is China growing. But nobody feels they can completely trust the numbers that come out of China. So you can now today, and 10 years ago you couldn't do this, but there are now services where they will view satellite feeds and count the number of ships that are coming into port to drop off. So you're starting to get import and export numbers that you can rely on, and so you can see trends. And so I think going forward, as that unstructured data becomes scalable, and you can really apply analytics, we're gonna see even better information on the active management side. And then a final piece, which I think is sort of interesting, is if you think about currency. So what is currency? Currency is a form of trust that you can count on, usually issued by governments, often in paper, and the backside, you might have the banks kind of digitally agreeing how to move it. Well, when you see things like Bitcoin, which are essentially non-government currencies, It's an interesting play, but I think over time, the digitization of currency is going to become very real. Already banks are starting to play in it by agreeing to certain formats. I suspect governments will also move in. And so what does that do? One, kind of from a key standpoint, is it increases kind of that level of security and trust. But two, it will allow the tracking the flow of currency in a way which we've never seen. And so a huge amount of transparency on that. And so I think that's going to have broad implications.
Well, and if you look at it from an India perspective, when you talk about digital currency, we've always talked about there is a big parallel economy in India, and, how do you really solve for it? And a digital currency may well be the answer to that. So that's quite interesting. Another question, actually, follow on in terms of the impact on technology. In India, we are seeing its impact on the customer servicing side. We also have trends such as the direct share class. So how do you see the client, basically in terms of the distributor and consumer relationship, evolving as a result of some of these trends?
So first thing, on kind of the direct share class. So since the commercialization of the internet, the demise of the financial advisor has been called. It's going to happen. I mean, it was on the front page of Business Week. Well, it's not going to happen. And the reason I think it's not going to happen is and it was funny, I had dinner last night with a very prominent person who said to me, my problem is when I look at numbers, it's just like they're floating in the air to me, right? I don't get it. And so it makes me nervous when I think about what I'm investing. So when Vijay talks about solutions, if you're a numbers person, you can look at, we'll present products, and that makes a lot of sense. The reality is probably 80% of the world looks at it and says, so just talk to me in the way in which I understand. I want to buy a car. What do I need to do to buy a car? I want to put my kids through college. What do I need to do? I need to make sure I have enough money for retirement. And so they need that financial advisor. And people say, well, the robo-advisor will fit that. Except when you look at it, and by the way, kind of across, I think we would see this across most places where we distribute products, that somewhere between 15 and 20% are kind of direct, and 80 to 85% get some form of advice. And what happens is, for those that go direct, oftentimes they enter and exit the market at exactly the wrong time because they have fear. And so what the financial advisor does, which tremendously improves returns, and there are US companies who have done some analysis on this, because the advisor will coax the individual back into the market when he's afraid to do it, and therefore he will capture the upside versus missing the upside and getting in too late. And so I very much believe that what will happen with many of these things like robo-advising and others, that they will become tools for the financial advisor for the segment of the market that wants to continue to have advice. And they will also be leveraged by the market that wants to go direct. And there was a company that came out maybe 20 years ago in the US called TurboTax. And in that case, they said the demise of accountants because everybody was going to file their US taxes themselves. Today, the number one users of TurboTax are the accountants who scale and are able to scale and provide it for the clients. So I think that's what we're going to see with the progression in technology here.
Great. Another theme which has an overarching impact in India is regulation. So Vijay, from a regulatory changes that, we talked a lot about the regulatory changes in India, but what are some of the other jurisdictions? What are the kind of regulatory changes you are seeing and the impact on our industry of that?
Yeah, I think we talked about it earlier at breakfast about RDR and the regulations in the UK, which I think SEBI kind of followed what the UK was doing, which was pass the regulation to ban commissions. And now there's a lot of talk in the newspaper about whether they're going to revert back to the old model, etc. But I personally believe that the arrows left the bow as far as commissions are concerned, even in the UK, because the client itself, the client wants advice, and they want a relationship with the advisor, not a transactional relationship. Because otherwise you're only good as your last trade. So I think while there's a lot of debate, there's a lot of noise in different countries. India, UK have done it through, through regulation. In the US, it's through evolution. But I think when I see how the rules are changing in Amsterdam or in Germany and in Switzerland, trajectory is all about moving away from the commission-based to a fee-based model. So I think that's the main regulation that is changing, which impacts the audience today. I mean, there are obviously other regulations, whether it's money market rules in the UK, in the US, use of derivatives, etc. But I think this is the key that impacts all our partners.
And so one of the impacts of advice, moving to an advisory kind of model, and I think that impact we've seen in the UK, is there's been a little loss of coverage of, for retail clients, especially the smaller ticket type investors. And so I believe there is some amount of reconsideration of that. But your belief is unlikely.
Well, I think Jenny touched on that what's going to happen, we're going through a transition right now. So you can pass a law and say everybody moves to a fee-based model. But what will happen is with the influence also of technology, you're going to get the bricks and clicks kind of model where there are going to be individuals who are with small sums of money who kind of get interact, but yet need hand-holding when it comes to volatility in the market. So yes, advisors cannot reach all of them. They will probably encourage you to do self-service, and it'll probably evolve very similar to banking, where 80% of your banking needs are done through ATMs and the web, but you yet need that 20% to go into a branch. So I think that evolution is really what is taking place.
So let's move on to the asset management industry in India. Vijay, you started our business in 1995. And over the years, you've kept a close watch on the developments in India. You're still active on our board of the AMC. So what is your view in terms of what's worked for the industry in India? And what do you think are some changes or in certain areas where we need to do more?
So first, give a couple of lines on what's worked for Franklin. I think, as many of you know, in 95, we struggled to even raise the first 50 crores. And today, the NAV goes up and down 50 crores a day. So clearly, it has worked for us. And if I can basically say what has helped us is basically three things. I think the Franklin values our colleagues, whether you meet a colleague in Korea or in Hong Kong or India or the US, they all are tied, they're different nationalities, different accents, different languages, but all tied to Franklin values. And I think the main Franklin values think about do what's right for the client, the business will take care of itself. So we have clearly come a long way in the last 20 years. I think in India, to give credit to the government and to SEBI, the two or three things that have helped the industry grow, one is the capital gains on equities. I think that has encouraged clients to actually participate in the equity mutual funds. The indexation in the fixed income, that has encouraged a lot of investors moving away from CDs and fixed deposits into the mutual fund industry. So I think there have been a lot of positive regulations to help grow the industry. Today is over $200 billion US. I think what's not worked in the one of the concerns I have, and we've raised this with SEBI many times, is the frequency of change of regulation. Is every month there's a change, and the entire industry, whether the advisors or the manufacturers, have to adapt, and then 6 months later it changes again. So I think one of the things, if we can, I know SEBI, AMFI, the Income Tax Department, Ministry of Finance, all are interested in the long-term growth of this industry. But in the interim, you're seeing changes in regulation which has impacted most of us. So I think that's really something that they need to set the stage, let the industry grow, and then again relook at the regulations every so many years rather than every month. Yeah. That has actually hurt the industry.
Jenny, we were talking a little earlier about regulatory arbitrage, and that's something that we see in India. So how do you see that impacting the industry, and just what are your thoughts around regulatory arbitrage?
the problem with regulatory arbitrage is it's never good for the consumer. And in the US, there was a little bit of, on the banking side, there still is a little bit between some of the regulators. And it creates conflict, and it always means that people will end up going with whatever is the easiest regulator. And that sometimes translates into not the best products for the customer. So that's where I think it can be very dangerous when it's not coordinated. In the end, you have to act not just in the slice and have a perspective of just the slice in which you regulate, but the impact of that on the broader environment.
Okay. So let's move to another area. From the start of the year, we've seen a lot of volatility. In fact, it's been very much a part and parcel of markets over the last few years. And what I find is that this volatility clearly impacts investor sentiment and basically the distribution business. So given that we have all of our distribution partners here, and if you're running a distribution business, what should you focus on in times such as this? I mean, maybe both of you can kind of take this on.
Well, I'll say that the best time to build relationships with your client are in bad times. Because that's, the easy time, it's, you're just collecting a trade and executing a trade. It's the hard time. So I'll give you an example. I think what you call trail here is 12B1 in the US. If you look, we're looking at a study that because of the trail fee in the US, post 2007, when the markets crash, to more recently, let's say 2014, 2015, the return that the client got was disproportionate, 1,000-fold compared to the trail fee. And if not for the trail fee, because the trail fee encouraged the advisor to hold the hand of the client in bad times and basically say, this too shall pass, whether you can dollar cost average or use a SIP, whether it is stay the course. So I think in volatile times, it's really holding the hand of the client, demonstrating that, yes, things are tough, but the stock markets have a tendency to go up and down over the long term. I think that's the key part in volatile times, and doing what's right for the client. The business will take care of itself as long as you are in the shoes of the client. That's why Franklin believes our clients are the advisors, and for you, your clients is the end investor. So as long as you do what's right for the client, I think the business takes care of itself.
I couldn't agree more with Vijay. There's a saying which I've heard attributed to several different people, but I think it was Teddy Roosevelt, but I'm not sure. But the saying is, they won't remember what you say, they won't remember what you do, but they'll remember how you made them feel. And that is exactly the point. When in volatile markets, your clients feel fear, and they will remember that you made them feel better. Now, if you retreat, their fear actually is even worse than what the reality is. And so it's getting timely communication. And since, again, scale is always an issue, that doesn't mean a personal visit or a personal conversation. It can mean an email out that describes what's going on. But the communication and the opportunity is so important. And if you do it right, the loyalty that is created in those times will carry you through for years.
Okay, I'm going to ask one question to each of you, and then we'll move on to the audience questions submitted through the app. Jenny, your family started Franklin Templeton in 1947, and the company has not only grown in size, but occupies a unique position in the industry. So, I was wondering if you could share your perspective on what makes Franklin Templeton so unique.
So I would say that it's the culture of the company and the culture, and people comment it, that, again, I mentioned we're in 35 countries, that you go into different offices in different countries and it's the same culture. And I always attribute that to really kind of my father's view and my grandfather's view, which was always you take care of the client, you focus on the client, and AUM and stock price follow. Right? So if you're always making your decisions consistent on what is best for that, the rest will take care of itself. And I think it is that attitude that, one, permeates the firm from a culture standpoint and is what carries us. And then the second thing, I think, when you have that kind of multi-generational view on things, is you make much longer-term decisions. And I think today on public companies, there's tremendous pressure on CEOs to, do this quarterly earnings and what have you done within this past year, and it's a much shorter time frame. And so in tough times, they tend to make short-term decisions that may not be the optimal decisions over the long term. And I think that we have demonstrated over and over that in those times, every business goes through its ups and downs, but in those cycles, that you're always focused on what is the best for over the long term and makes most sense for the clients.
Thanks. Okay, so Vijay, throughout the day, you're going to interact with the audience. I'm sure you will bump into a lot of your old friends and make some new ones. Any special message for the audience today?
No, the only message is thank you. I can't say that enough. I mean, all of you I've met many of you even this morning who came to me from Indore, from Ahmedabad, from Baroda, Pune, talking about how you all have basically helped us build the trust over the last 20 years. So thank you for that. The other message I'd like to leave is, like anything else, the industry will evolve. And all of us need to recognize, whether it's Franklin Templeton or you as advisors, that what got you here is not going to keep you here. You need to constantly reinvent yourself, reinvent your model, reinvent the way you do business. You should not change your core values, should not change what is core to your business, but the way you do the business is going to change. Technology is going to disrupt. There's no question. I mean, I talked about how banks have changed from, where 80% of the business is done through the internet and ATMs, but advice is always going to be required. And I think you are in one of the best industries in the world, because the good news about India is the penetration rate in India is so small. So the opportunity, frankly, is infinite. The question is, how do you execute? So and this is the only vehicle, the mutual fund is the only vehicle that allows individuals to convert cash flow into long-term wealth and participate in the growth of the economy. So you're in a great industry, you have a head start, the penetration rate is so low. So the question really is to see the next, and I hope I'm going to be obviously back more often, but 20 years from now, we're going to see a substantially larger industry, which is way beyond our wildest imagination.
Thanks. Let's start with the audience questions. I think, Vijay, the first one is for you. I think this is a follow-on from what you were talking about, the move to advise. And what are the parameters on which a distributor should charge fees? Can you throw some light on how does it happen in developed markets? So I guess the question is about, what is the consumer really paying for? And so I don't know what you're...
I think it's basically a little bit like, I say it's like the travel business. So you have, in the old days, you went to a travel agent just to get a ticket, but I think those days are gone. But if you have a complicated trip, you will yet go to a travel agent because you want advice. You want the travel agent to explain to you exactly how far is the airport for the hotel, what you should do in a particular place. So you need that travel agent, or you need that advice. The second platform is just going onto a Travelocity or some website and buying your airline ticket. And these are the various platforms that are coming up today, even in India, where people will go there and just transact. And then the last is going directly to jetairways.com. We are not, and in India, of course, regulations require that you can go on the direct share class. But I think the first part is the key, for any advisor to focus on that. And I'm sure over time, I know it's in early days yet and the market is not as mature, but clients will pay for that advice and they will remember you when you've helped them in the bad times. So I think that's the key area of the evolution.
Thanks. Jenny, we have a question for you. I guess it's a similar one, but from an external perspective. Any learnings from distributors in other countries that you want distributors in India to follow?
I think that what holds true across the board, and we've touched on it multiple times here, is doing what's right for clients. And, as we mentioned, things like regulatory arbitrage or whatever those opportunities, wrong product sold to a client. If you don't do what's right for the client, then over the long run, that you will lose that client. So, for example, when we talked about regulatory arbitrage, one of the things that we saw in India was that the insurance products, you were paid bigger fees. The regulator was, the mutual fund regulator almost was pushing people in that direction, but it was not as good of a product as a mutual fund, right? So it's so tempting to go to that direction. But if you actually ultimately look at what's right for the client figures it out, and that's the experience that we've seen. My father always said that he would get frustrated by bad actors in the industry because it burned everybody else in the industry. And you will lose a client for life. The industry will lose a client for life if one person doesn't treat them well. And, and that they then tell X numbers of others. So to me, I think the key message, and that means it means putting them in the right product, not necessarily always the easiest product to sell, the right product that meets whatever their needs are, and having the patience to understand truly what their needs are, because clients aren't always able to articulate it so crisply right out of when you're first talking to them.
Okay. We have another question. Vijay, in India, charging fees follows a bargaining culture. How does it work in other parts of the world? So the big belief and the big issue with advisors, the belief is that firstly, Indians will not pay for fee. If they do, they're going to bargain for it. So is it really different in other parts of the world?
I think India takes it to the extreme of bargaining. But I think I want to kind of turn that around a little bit, because my heart is to see how your businesses grow over time, and I believe it will grow in the right way. So yeah, people everywhere in the world wanted the right deal, etc. But I know in India right now it feels that you're doing all the hard work and you're not getting compensated. But I look at the hotel that we are in today, JW Marriott, and you also have across the road Courtyard Marriott. So I encourage all of you to basically say, if you have the skill set and you genuinely have advice, you have the analytical tools, you say, I'm providing you a JW Marriott experience. But if you should choose to just transact, you can go to the Courtyard Marriott under your own brand. And you can always have two different channels under your own, umbrella. So a lot of people do that. You say, listen, if you want the advice, and in the US we have Fiduciary Trust, which is our private wealth management business. Their level of expertise, their advice on wills and estates and trusts justify the fee. But on the other hand, if you just want to buy, a mutual fund, you can go to a platform. So I think here over time you are going to see an evolution, a separation. Right now you are providing the advice and people are trying to bargain on them. But I think over time, if you separate the two and allow your clients to pick between a full service advice and kind of a light advice, you can differentiate your fee structure.
Thanks. Do we have other questions from the audience?
How do you, so Harshendu, you asked Vijay and Jenny this question already about the digital play out. How effective will be the e-commerce companies in this, the change of game in India? And where I'm coming from, Vijay and Jenny, is that we in our industry, I believe, we are a little antiquated in our mindsets, and we're not changing our mindset fast enough, and hence technologists are coming and looking at this business afresh and are beginning to disrupt it already, and there are already initial signs. So what change would you like to see in us? So two parts of question. What change do you see happening? Do you see these technologists coming and disrupting us? Or to defend ourselves, and you alluded to that earlier, what changes do we need to bring about decisively in our community whether we are regional, national, or IFA at a local level, what changes do we need to bring in our own way of working to be not only survive but be successful going forward? Thanks.
Thank you. Any of you?
So I would first say, fortunately, there's all these great new technologies coming in because it is the only way that you can reach the scale that you're dealing with in India. So the first thing is, that is a huge advantage. And then the question is, how do you leverage it, right? And as I mentioned on that TurboTax example, and all the tax accountants in the US now using it, it has allowed them to scale. But everybody will always say it'll completely disrupt. But you will be forced to prove your value add to your clients. And that value add is, my experience in technology, technologists can speak to each other in their own language, but the people who tend to manage technology teams are great at translating technology for the rest of the world. And why is Apple so successful? Because they make really complicated technology really easy to use. And so that's the role that the financial advisor plays. And so harnessing the power of that technology in a way that makes you more efficient and scale to meet your client in the way that they need you to meet them, and in a way that you communicate can understand in terms of solutions. Solve this problem for me. I think you will find that there's a huge advantage. If you don't embrace those things, then you're going to find that the client says, why am I paying you for this? And so I think it can be a huge value. The millennials, I have 5 children, and I look at my children, and I have no idea how they communicate at times with each other. So there is definitely a younger generation. It always surprises me that they'll sit next to each other and be on Facebook talking to each other. So those things will definitely evolve. And we'll have to evolve with it. But that still need for empathy and communication is really critical, and somebody needs to translate it. And then the only other thing I'd say, I know a lot of really smart investors, and at the point where who are capable of doing it themselves, but at some point in their life, they realize that they now have enough money to do a lot of other leisure things. And so they would much prefer somebody to deal with it and hold their hand and take care of it. And they'll check them and hold them accountable, but they still prefer to have the advice handed off by a full-time expert doing it. I don't know if you want to add.
Yeah, I think it's more very similar to what Jenny said. But technology will disrupt, but I look at it not as a negative thing, but as a positive. One is it allows you to increase your reach to hundreds of more clients all over the country. And second, so that's the breadth, but I think technology also helps you with depth. Because if you can offload 70–80% of the work, where people are coming in for an account opening form or a fact sheet or some updates to your respective branches, if you can offload all of that on the web or through your smartphone, then your advisor in the branch can upskill. You don't need the real estate. The most expensive thing in India today is the real estate. You have, Rajiv, you and I spoke, you have these hundreds of branches all over the country, even in Delhi you have, but the cost is going up. So you can, like Citibank has done in India, you can actually reduce your branch size because you don't need that many, technology can deal with the breadth. And your advisors can scale up in providing that advice. So I don't think advice and the role of the advisor will ever disappear. It'll just change over time. And technology will enable that.
Thanks. We're out of time. I would like to thank both of you for sharing your perspective, and I'm sure the audience will look forward to interacting with both of you during the day. Thank you.